What is an inverted yield curve and how does it affect mortgage rates? If you're in the market for a home as a home buyer or a realtor, you may have heard about the inverted yield curve. But what does it mean for mortgage rates? Hello, this is Selland with Signet Mortgage, and in this video, I'm going to share what an inverted yield curve means for mortgage interest rates currently and into the future. Let's first understand what a yield curve is. A yield curve shows how yields on various government bonds change over time. A normal yield curve shows that long-term bonds, those with longer maturities, offer higher yields than short-term bonds, which reflects the investor's expectation of future economic growth. Viewed as safer and less volatile than equities, investments in treasuries or other government bonds still expect to have a higher return over time. An inverted yield curve occurs when the short-term bond yields are higher than the long-term bond yields. This is an indication that investors expect slower economic growth in the future. Investors have a pretty good handle on the short term, but have concerns about the longer term. I'm sure you feel that way right now, and we're doing this in April 2023. How does an inverted yield curve affect mortgage interest rates? When the yield curve is inverted, it usually means that mortgage interest rates are also down as rates are tied to mortgage-backed securities or bonds. This is because long-term mortgage rates are tied to long-term bond yields. This makes some sense because investors are expecting lower inflation and slower economic growth in the future. So they demand lower returns from their investment. Okay. As such, investing in mortgages becomes more attractive to lenders because they can get better returns on their investment without taking on too much risk. Therefore, when the yield curve inverts, lenders are more likely to offer lower interest rates to borrowers. Okay, that would be normally, but with the Fed so active in trying to bring down inflation, it's caused current mortgage rates to stay high because it's an open question how long it'll take to get inflation down to what the Fed wants. What we have seen is as soon as the Fed begins to ease their hikes in the Fed funds rate, we will see mortgage rates ease. When is the question? It's important to note that there's no guarantee that mortgage interest rates will change with the yield curve. It just means that there's a good chance they will in the future. Ultimately, whether or not mortgage interest rates go down depends on how lenders choose to respond to the changes in bond yields due to an inverted yield curve. It's important for all of us to stay up to date with shifts in the financial markets so that we can make informed decisions about our finances and investments accordingly. What I am advising all the clients we are working with now and will into the near future is that rates are likely to be lower in 12 to 18 months. So live with the higher interest rates, move forward with your plans, but include in that outlook that there could be an opportunity to refinance to a lower rate in that time frame. Thanks for watching. Again, this is Selland from Signet Mortgage. If there's anything we can do for you with respect to residential financing or anything, don't hesitate to contact us. We look forward to helping you and answering your questions going forward. Take care.